Hello and welcome to the Gold, Goats, and Guns podcast for today, Tuesday, May 19th, 2020. It's my great pleasure to have with me the project lead on a crypto project called Decred, which you may or may not have heard about. Now, I've been involved with Decred for over a year and a half or so, and I think it's a phenomenal project for a variety of reasons. And I've got the project lead on this, Jake Yocom-Piatt, is with me today. We're going to go off board. We're not going to talk geopolitics. We'll probably talk a little COVID-19 because how can you not? But we're going to do all those things and we get back into the crypto space because I think with the Bitcoin halving and with the insane money printing from the Fed and everything else that's happening right now, crypto occupies this very interesting potential space as we move, I think, into the next phase of its development as a monetary asset or as a group of monetary assets. So I'd like to welcome Jake to the show, and thanks for taking the time to hang out with me today.
Yeah, it's great. It's great to be on here, Tom. I've been a fan of your writing for quite some time, and it's always a pleasure to speak with people who live a little bit outside the box in terms of the content they produce.
Well, yeah, I certainly do attempt to do that, and I'm really, really pleased to have you here today because crypto for me hasn't really been much of a focus for a while now. When you're in a grinding bear market, it's very difficult to just summon up any kind of enthusiasm. But at the same time, from my perspective, you have to go where the story is, where the dominant story is. And for the last 2 years or so, it's really been a different story than crypto. But with the halving in Bitcoin and with what looks like a new bull market happening in gold, and the two of those things happening at the same time, I think in parallel, I feel very strongly that Bitcoin is becoming a safe haven asset alongside gold to help people, certainly retail and even family office investors, get away from the crumbling financial system that's in evidence all around us. And so I want to talk about those things today, and I'd like to talk about why Decred is an interesting project vis-a-vis Bitcoin. And so why don't we start with that? Let's just talk about Decred in general, because you have a very interesting security model that I think is so orthogonal to Bitcoin and so interesting that it should help touch off the rest of the conversation. So take it from there.
Yeah, I mean, I have a long background in the space. I've been working in the space since late 2012, early 2013. And I used to work on Bitcoin, so maybe we could start there for just a minute. And
sure,
what really drew me to Bitcoin is that even back in 2012 or 2013, the thing that stood out to me about Bitcoin, per your comments about the Federal Reserve and so on, is that in this wanton central bank credit issuance that's going on all over the planet, is that Bitcoin was just a fairer system. That's really what and I feel like a lot of other people may share the same sentiment, but they can't really articulate it. Mm-hmm. So I feel like that's an important thing to talk about, is fairness, right? Because I saw Bitcoin as fairer because there's no single person there who can just go, you know what, I don't like Jake, and click a button and then deny me an account, freeze my funds, or anything along those lines. And so if you've spent any amount of time working with banks or running a business, you know that these things can and do happen. And sometimes they happen, under incredibly questionable circumstances. So, that's what really drew me into the space. And I've been working with a team of developers writing Bitcoin software between 2013 and 2016, and then working on Decred from early 2014 on. So there was an overlap period where I had teams working on both of these things. And what we're trying to do with Decred is we're trying to take it a step further. While Bitcoin is obviously a huge step from fiat banking, it also has some shortcomings in the sense that, hey, maybe it's fair in the sense that you can store and transmit value without much fear of repercussions, but it's not. There's other things about it that aren't very fair. So that's really what drove me to go. Bitcoin's great, but how do I continue following this gradient of fairness to create a better system? And that's why I ended up meeting up with a couple of pseudonymous people online going by the names of Taco Time and Ingsoc. We worked together for a couple years, and then we were able to pop out a release in February of 2016. So the idea with what we've done is that we, Bitcoin is great, and it uses this mechanism called proof of work to secure its chain. Now, that's
Right.
a great way to approach things, because what it does is it forces people to do calculations that you can quickly verify, so that they can't fake that what they call it work. So you can't fake the work. So there's this process of performing work that no one can fake, but is also very quick to validate. So that's proof of work, and that's where everything started. Now, the big problem with proof of work that starts to come up is that proof of work weakly aligns incentives between the miners and the network. So the people performing these proof of work calculations, called miners, aren't as strongly aligned with the network as you might like. So, for example,
Right.
they can do things like censor transactions and all of this other stuff. What we decided to do with Decred was to bring governance to that scenario and put proof of stake on top of proof of work. And proof of stake is the idea that you can prove cryptographically that you control coins on a blockchain.
Mm-hmm.
In addition to the fact that people can perform mining operations to basically time order those blocks in the chain. So what we did is we combined those two things to make it so that the people who hold the coins are the people who have ultimate sovereignty within the system, as opposed to the people who mint the blocks. And that gives us really strong incentive alignment. And the big idea is that we're trying to create a community, a community that's directed by the intelligence of its stakeholders. So all of us working together using this proof of stake mechanism can make collective decisions for the network using our participation in the proof of stake process.
Right.
And then from there we go, that's a big step up in terms of fairness and making the system fairer. There's no longer 5 people who control everything about the project. It's a group of us. We're all working together. And so, we try to do this by doing 3 things: increasing the security of the chain, and that means relative to things called majority attacks. We could get into that later.
Mm-hmm.
The second thing we do is we try to make the system adaptable, so that if at some later point you're like, oh, hey, I really want to change. I want to make bigger blocks. I want to make smaller blocks. I want to add this. I want to subtract that. You can do that, and we can do it together by making these decisions as a group. And then the third thing we do is we try to focus on sustainability, because something that I experience in the Bitcoin space is that it's very easy to spend money there, but it's very, very difficult to make money as somebody who's building out the infrastructure. So it's you spend millions of dollars building out software, and people are like, wow, it's great software. Here's $5, and I'm like, wow, I got and it's very much akin to what you've been doing, where you're a writer and your income is dependent on the generosity of others in a lot of cases.
Right.
And so we tried to engineer that part out by funding our own work.
Okay, so why don't we go into that a little bit more? And as an aside, I've always thought, and I've been I don't know if you know this or not, but I was in Bitcoin when it literally first went live. And I think I was user 36 over the original Bitcoin forums. I wrote an article on Lew Rockwell that was published in July of 2010 on Bitcoin. And I was the first one to tackle it from the perspective of Mises' regression theorem as well, because I had to explain it to Lew Rockwell and Mike Rosef and Tom Woods and others who were all going, it's just fiat, just fiat electronic money. I'm like, no, it's not. So I've always thought that Bitcoin was just kind of alpha code that went viral, and it was such a powerfully important idea that it was able to go crazy simply because there was such a need for something like it. Not necessarily Bitcoin itself, but something like Bitcoin. So this is why I've been far more fascinated with the altcoin space than Bitcoin itself for a long time now, because to me, I just looked at the code and went, no, that's really not scalable. And Bitcoin has obviously been going through growing pains and whatnot. So what I found interesting about Decred, and it's what I really like about it, is that there's an economic disincentivization against a 51% attack, or any kind of an attack where the blockchain could be taken away from the people who own it, and then we get into counterfeiting and all the rest of it. And in a pure proof of work system, it's the 51% attack, where someone takes over 1% of the blockchain and then double spends their existing coins and counterfeits new coins. There are other coins out there that are doing a better job of that doesn't protecting against it. And I think Decred is one of them. And so I'm really interested to for everybody to understand what that fundamental difference is. Because when I saw it originally, it was like, oh yeah, this is so obvious. Like to take over this blockchain would cost more than the blockchain is worth. So take it away.
Yeah, sure. And so what you're touching on is you're touching on the security aspect of
Yeah.
blockchains. So
Mm-hmm.
the purpose of security in the context of blockchains is that you want to make the whatever blockchain you're working with secure against you called it a 51% attack, and it also goes by the name of a Finney attack.
Mm-hmm.
And then I prefer to call it, rather than call it either of those, I prefer to call it a majority attack, because it's
Sure.
actually something that comes up a lot in the context of the media. And what's going on there is that people can, if someone goes back and rewrites history, that's bad, for a lot of people. Like, I don't
Right.
know, you're a blogger online and you deliver some really high output deliverables, and somebody goes back and effectively tries to rewrite you out of the story.
Right.
That's obviously, that's undesirable. But in the context of time ordered transactions, which is really what these value storage and transmission systems are about, that's
Mm-hmm.
that you're going to absolutely break the system. You can steal money,
Yes.
you can cause all kinds of problems. So that security aspect is super important. And the way the sort of revolutionary solution that that the Satoshi Nakamoto group put forward is that you can solve this problem by, instead of trying to make an absolute solution, which is irrevocable and always the case, you can make it very, very expensive to rewrite history. And that's the approach they decided to take, so that everybody who's a proof of work miner, you perform these calculations, and when you're performing the calculations, you can't fake them, so that that part's solved. And then the other component to think about is that when you do this, it's an open, permissionless process, so that when people do this, they're spending money and everyone's in competition. So to go back and rewrite history becomes incredibly expensive. And that's great, but as I mentioned earlier, there's some shortcomings with it from a censorship perspective, right? Like,
Mm-hmm.
let's pretend everyone who mines Bitcoin is in China, and there's a huge amount of hash power in China,
Mm-hmm.
and they don't want to mine certain transactions, or they want to mine empty blocks. There's nothing that can be done to stop that kind of problem from occurring. On top of that, in a pure proof of work system, the people who run this computer hardware have a monopoly on the right access to the ledger. That's what I mean when I talk about censorship. And when we talk about security, it's like, okay, so there's these people running these special machines, and they determine what is and is not, included in the blockchain. The problem with that, there's some sovereignty problems with that. It's not a great sovereignty mechanism.
Mm-hmm.
But then you start to go, okay, well, let's pretend, what can we do to improve that security model? What we could do is that we could interleave proof of stake with it. And what proof of stake is instead of performing these calculations, which is proof of work, you end up going, hey, I control a certain number of coins, so I should have a certain amount of sovereignty within this system. And, and here's an example. Let's say you control 10% of the computing power, of the hash power for a proof of work network. Mm-hmm. Then it stands to reason you roughly mine 10% of the blocks. If you own 10% of the stake in a proof of stake network, it would stand to reason that you have sovereignty over, I don't know, roughly 10% of the blocks, however that ends up shaking out. Sure. So what we did with Decred is that we interleaved the two. So every block has proof of work done, and then there's a proof of stake section, which is actually validating the prior block's proof of work. And what that ends up doing is that ends up effectively creating a two-factor authentication kind of scenario where, sure, let's say let's say you're a nefarious person, you have a whole bunch of control over the mining network, and you want to try to make a majority attack in the proof of work context. Mm-hmm. You might be able to pull it out for the proof of work, but the stakeholders may go, that's not going to fly, and then they can actually stop it when in the successive block where they validate that proof of work for the previous block.
Exactly.
So this gives us a two-factor authentication. The other thing that it does, beyond these sovereignty problems, it puts proof of stake in control, which is, sort of like makes sense, right? It's more like the shareholders than it is, say the bookkeepers. Because I think the analogy for proof of work is that it's a bunch of people writing down records, and if you alienate yourself from those people, it's bad. Whereas when it's the stakeholders, it's like the incentives are very strongly aligned. And so what ends up happening is that this ends up having a multiplicative effect on the cost of running a majority attack. You need to have a massive amount of stake and a massive amount of hash rate in order to attack a system that has a consensus system like this. So that's where all of these ideas were coming from in the context of Decred, which is that we wanted to fix the sovereignty problem, which we did. So proof of stake is sovereign. We wanted to make it very expensive to attack, and then we also wanted to add a component where people can participate. Like let's say I'm a proof of work miner and I sell every one of my coins I mine. Then there's a guy down the street from me who's also a proof of work miner, and he keeps every one of the coins he mines. If we ask most people who hold, whatever cryptocurrency we're talking about, who do you think should have more sovereignty in the system? I think most people would agree that the person who's holding all those coins versus just dumping them on the open market should have more sovereignty in the system. So, we've tried to do a many birds with one stone approach with that.
All right. No, and that's what when I first read about the project, that's what drew it to me. It's the first thing I did. And then whenever I evaluate a crypto project, and people ask me about them all the time, I always go to, okay, so if I'm George Soros and I want to destroy this thing, how would I do so? Because if I'm Soros or I'm Gates and I've got $50 billion to spend, how would I take this thing over? And when I looked at the model for Decred, it was the ticket system is very interesting. And we don't have to go much further into the technology of it, but the ticket system is incredibly interesting because what it winds up doing is it winds up creating an economic barrier that is where the potential return on trying to create a majority attack is less than what you had to spend to get there in the first place. As long as the price itself relative to the value of the hashing power, as long as those things are aligned, there's a very low order probability that anyone could, one, take it over, and two, because it's not worth it for him to do so unless he just wants to destroy and is going to be a vandal about it and just destroy the whole system. And that's always a potential problem with any up and coming crypto project is the potential for just pure economic vandalism, especially in an age when people can print trillions of dollars and then use them for whatever purpose they want. But that being said, and honestly, that's an outlier at this moment in time, because no one that I could even imagine would be looking at this project as something worth them attacking. And given that Bitcoin itself has so many potential issues, as you just outlined, wouldn't they be more threatened by Bitcoin than one of these smaller projects like Decred? And I happen to put like Komodo and a couple of others that use different security models, but are just as strongly disincentivizing for majority attacks. So
I think there's definitely an incentive for the powers that be to attack. Basically it's like a prison yard. Like this sort of urban myth about you're supposed to go in and punch the biggest guy you can find in the face.
Right.
And to some extent that's bound to happen in the context of cryptocurrencies. That is that if you look at if we talk about narratives, I mean the narrative that people have really been focusing on in the for Bitcoin has been that bad people use Bitcoin, and it's like
right.
Well, any of us, anyone with half a brain knows that, bad people use shoes, bad people use cars, bad people breathe air,
exactly.
The criteria of do bad people use it is a really poor way to frame anything. So to me, seeing that kind of narrative, be a target, for people to set it indicates to me that Bitcoin has to some extent been in the crosshairs for quite a while now.
No, I agree, and I think it's really funny the way they're going with know your customer and anti-money laundering rules, and the way they've weaponized the dollar and the use of it. We're at the point now where if you use dollars, you're a money launderer, so you're a bad person. In every way, every day as the system collapses, they will broaden the definition of what money laundering is in order to try and clamp down our operations, anything we're trying to do. Where they're going to try and outlaw cash, they're going to try and move to full digital currencies and all the rest of it. All those, the headlines are everywhere right now. So it's very obvious that that's where this is going. So it becomes really rich to say, oh, well, only bad people use cryptocurrencies. Well, that's not the case anymore. One in five people know about Bitcoin easily, and then certainly 1 in 10 people have either bought some or are willing to buy some at this point in time. And now we've got ETFs, you've got futures contracts. It's a semi-professional market now. And I don't consider it a professional market. Then again, I don't think anything's a professional market at this point, not with the vandals that are running the world. But that being the case, it's quote unquote more professional than most of the crypto space. So I think that we're at that moment in time where things are beginning to turn and things are beginning to change. So it's a very interesting thing that now it's becoming legitimized. Now the governments are going to create their own cryptos, which are effectively, they should just be SQL databases, but they're going to call them cryptocurrencies. So I don't know, man.
So something I find really interesting about the central bank digital currency thing is that there's a lot of talk about it, right? And then People's Bank of China is really, it seems like they're making some of the most, prominent strides towards, a in production central bank digital currency. And something that, that people come up with is like, oh, they want to do it so they can surveil everything you do. And then that's part of it, but to some extent they can already do that. That is that, they tap the commercial banks that generate all the credit, and then they have those people monitor you on their behalf. So to some extent, the panopticon is already in place. But the thing that I feel like is overlooked is if you ask the question, why would central banks be interested in making their own quote unquote cryptocurrencies, I think it really has to do with the credit creation process. If they have to rely on commercial banks to create the credit, when there's a credit contraction, they then have to publicly recapitalize these banks. Whereas if they have their own, top-down central bank digital currency, they could go, you know what, I really like Tom, let's give him a whole bunch of credit, and no one else knows about it, right?
Right.
Whereas, or they could go, you know what, I really don't like Jake, let's not give Jake any credit. In fact, let's take his money away. Right. That is the real, that's the real magic of, central bank digital currency, is that it allows completely localized credit issuance that can be entirely opaque. And that's something else that I think is kind of funny in the context of central banks and cryptocurrencies, is that no matter what central banks try to do right now, they can't be fairer than Bitcoin or other cryptocurrencies. No. No, so that's and so they're always going to be fighting, they're going to be fighting the current here. The current is that people want a fairer shake at life, at everything around them. And so like central banks are like, oh, well, let's just make it a little bit more rigged and maybe no one will notice. And it's like, yeah, they'll notice. Maybe they just won't notice as quickly.
No, no, it's very obvious. Just going through the text of the first coronavirus bailout package, the CARES Act, it was so obvious that, okay, well, we have to give you $1,200 because if we don't give you anything, then it's going to be, there'll be outrage. Right. And at the end of the day, it's always like $1,200. I was saying this the other day. Have you ever noticed it's always $1,200? Because $1,000 is just that. It's such an A/B tested number. It's like $1,200. It's more than that. It's more than $1,000. It's $100 a month. Because if it's less than $100 a month, then it's not. It's just kind of sick. And at the end of the day, what does it come up to? Like a $30 billion out of a $3.5 trillion package, where most of them are $3 trillion package, where most of the money actually just went into the black hole of derivative deflation. No, it's ridiculous, and they're going to do it again, and they're going to continue to do it again. And they're hoping that they can. Like I've been saying that for weeks. I'm like, why don't you just do the Pelosi thing? Just give everybody $2,000 a month, but don't give anybody else any other money, because all that money's going to wind up at the banks anyway, because everybody's just going to pay their mortgages with it. Everybody's just going to pay their property taxes with it. Like you're not. All the money's going to wind up in Wall Street anyway, because that's where all the money's has to go, because. I think that's where people spend 90% of their money.
Oh, well, I think
it's where 80% of their rent is.
Yeah, and I feel like it's easy to forget because the Federal Reserve System has done a great job obfuscating who controls the system and how it works. Mm-hmm. And in short, if you look at the way people get elected to the open market committee is it's basically people appointed by the president. People appointed by the banks, some people appointed by industry, and that's pretty much it. And so it's like, big surprise, we bailed out the government, industry, and the banks, and everybody else can go more or less suck an egg.
Right.
Because, like, hey, you and I aren't buying bonds on a daily basis, so we're not going to be able to, suckle on the teat of the Federal Reserve System. Whereas, big institutional investors that have basically, tied us to a giant rock can just like, effectively print money by blackmailing everyone with their incompetence.
Oh, it's absolutely the case, and you're absolutely right that as we move forward, as humans, I've been saying this for a while, that what the most brilliant thing about Bitcoin early on in its conception, or proof of work, the original white paper. And I remember reading the white paper back in 2010 when and I'm like, oh my God, this is going to change everything, because it was the first time that the issuance of new monetary units did not have any human input. Humans had to work to create those monetary units, but the amount of them had nothing to do with humanity. For the first time, even gold, right? At the end of the day, gold is still the gold miners still have to decide whether they're going to mine those ounces or not, and how many ounces they bring to market is based on their particular economics, of the particular mine, right? And how much gold is there? What's the grade? What's this? What's that? All that stuff. Bitcoin, every 10 minutes, 50, or now 6.25. And so with the halving, everything's changed, and that is a fundamental shift in money. That's the first time this has happened in the history of money. And I think it's a very interesting evolution, a very interesting technological innovation. It's a new and better tool, because what we've proven as a species is that if you give us access to the cookie jar, we're going to eat everything and then go to the next cookie jar. We are not going to not print money. I mean, I've said this for years. If printing money didn't confer such an unbelievable advantage on the people who print it, people wouldn't use credit cards, because credit cards are printing money. They're printing credit out of whole cloth, and I'm going to create purchasing power in the moment against my future labor. It's no different than what the Federal Reserve does. They're just doing it against they're just doing it involuntarily against your will, against your future labor. It's fundamentally different, right? Which is far more tyrannical. So it's this moment in time where even the discipline of gold is not as important as the discipline of Bitcoin. Now, sure, we can make new coins, which is like making new, but the market has to accept those coins, and the market will only accept those coins if there's a greater demand for money. But with digital money of this type, that's infinitely fungible, because we can just keep adding leading zeros to the expanding division of labor to make finer comparisons. We don't need more Bitcoins. We just need a different way of denominating those Bitcoins. As opposed to calling them Bitcoins, we call them Satoshis, right? Which are 10 to the minus 8th Bitcoins, right? But we have an infinitely fungible currency, which we've never had before, whose issuance is divorced from human action and human discretion. That's never happened before, and it's unbelievable that. And I think it is the most important technological advancement of the past 50 years. It's more important than the internet.
Oh, I mean, I'd go so far to say as the model from Bitcoin for gamification. Basically, it's turning timestamps into a game. Is the most significant financial innovation since the Medici's created double entry accounting.
I was going to say, yeah. Yes,
it's really the next thing, because but at the same time, it's so powerful, but there's all of these prerequisites. Like, for example, you can't do this stuff without public key encryption systems.
Sure.
So without public key encryption systems, which were invented in or quote unquote invented in the mid to late 70s and early 80s, I mean, none of this stuff goes. So it's really something that's always held my attention about it too, is that you combine all these random components and you get something amazing. And you were just talking a lot about the deterministic issuance of Bitcoin, and I feel like deterministic issuance is a prerequisite for something to be a good store of value. That is, that you can predict what's going to happen, so you can manage your own expectations to be like, listen, I know that the mining rate is X now and it's going to be Y in the future. And, the ability to know the future in terms, in terms of the monetary system you opt into, that's just so much more powerful than anything a central bank could do. And I feel like, it's the natural conclusion of a thought process where you go, well, if banks, fiat banking, people can effectively snap their fingers and make fake money appear, and you can spend it and do whatever you want with it, like it's quote unquote real. And just to go, that's not reasonable. Okay, well, what is reasonable? What if we told everybody how much money was going to be made from here until we stop making money?
Right.
And I feel like that manages everyone's expectations so much better, and it's just so much fairer. And then another thing, because we're talking about the deterministic issuance and how fair that is, I think it's also important to point out that the issuance process, not beyond the amounts that are issued, the issuance process is also incredibly fair, right?
Yes.
Which is people, we all compete to perform these really difficult calculations, and whoever can, objectively perform these calculations best gets the wins, as opposed to who looks best in a suit and who kissed Jamie Dimon's ring and all that kind of junk, where it's like politics and positioning and jockeying, that's all out the window. It's who can crunch these calculations.
Well, and take it one step further, and then look at what you guys have done with Decred, which is that you pay those guys, they get a certain amount, the guys who did the calculations, but also the stakeholders themselves get a payback for staking their savings as to be the guys who will validate. So the validators, this is the interesting part about the proof of stake system within Decred, which is that if you own Decred, you can, as opposed to just holding it in a wallet, you can hold it and you can put it back into the system to be one of the people who validates the proof of work blocks, and then you get part of the payout when the new block is validated. When that block is validated, and therefore you're getting a return on your savings. So Decred has within it its own savings mechanism, which is why there's an economic incentive or disincentive for any kind of majority attack, because, well, it costs Decred to buy the tickets, to be the guy, to be able to validate that block, right, within Decred. And that again democratizes the issuance. So we're going to create new monetary units. We all know what it's going to be, and we all know it's going to be deterministic. But everybody who's part of the monetary system, so now the people who use the money and the people who save the money, or are the people who are deciding the future of that money. And that, as you said earlier, is fairer. It's not just fairer, it's exactly the way it should be. And we, again, never had the opportunity to do this previously because of the way, just because of the way it's happened in the past. I can sit here and tell you we could talk an hour about how corrupt the gold mining industry is, right? And gold is, next to Bitcoin, is the fairest thing out there, or silver, or whatever you want to call it. So it's fascinating, and I just wanted to put a bow around why the security model within Decred is, I think, so sophisticated and so I think vital. Even if it doesn't work, even if at the end of the day Decred is just beta and there's a better system out there, it doesn't matter. What matters is that this is break it down into its component blocks and note what it's capable of doing, and note how much better that system will be in the long run for everybody who actually has transacted value for value and decides to store it, spend it, or do whatever, and they retain their sovereignty, because we need to get back to monetary sovereignty.
Yeah, I mean, something that I feel like, if we made comparisons, it would be that Bitcoin is sort of like it's like a credit union to some extent, mm-hmm. right? You can deposit your funds there, you can store them. You might be able to get some credit, but it's not like a big box bank where really their big business model is credit, and they want to get the interest on the credit from you.
Right.
So they want to produce fake money and get a return on producing fake money from people who make real money.
Right.
And so Bitcoin doesn't have the credit issuance component, but it has the storage in the transfer part. I feel like what we've done with Decred really kind of turns it into more of a central bank, right? Because by putting the stakeholders back as sovereign, What we then have is we have a collective decision-making mechanism on top of the time stamping.
Mm-hmm.
And that collective decision-making mechanism allows us to do things like go, hey, maybe we do need to turn down the issuance rate, or maybe we do need to turn up the issuance rate, or maybe we need bigger blocks. And there's all these decisions that you have to make.
Yep.
And in the absence of a proper sovereignty system, you just can't make these decisions. I mean, anyone who's familiar with Bitcoin knows that 2016 and was it 2015, 2016, 2017? It was a hell of an argument to get them to activate the segregated witness census change set. And it was like, people just fighting like cats and dogs on Twitter for years before effectively the community was ready to, storm out the door. So the ability to make these decisions and stay sovereign is so important. I mean, here's another question. How, if the, Federal Reserve policy was a function of voting on part of people who held US dollars, I mean, I wonder if we would ever see these ridiculous target interest rate changes that they just come out with whenever the economy's doing bad. It's like, oh, the economy's doing bad. Let's turn the knob to zero. I think a lot of people, would disagree with that policy. They'd be like, turn the knob to zero. You're not turning that knob to zero. That's going to wreck my business,
Well,
and
it's going to wreck savers. And what you're saying here is that, look, in the Decred model, the people who are willing to save their Decred for a rainy day for the future, and you've given them an economic incentive for doing so, you're supposed to get a return on your savings. In classic banking, I would actually argue that you're actually closer to a classic banking model before the central banks than we have today. Where today, what we have is a bastardization of classic banking models, right? Because the bank can go to the Fed to go get more money if it wants. It can go into the interbank markets to get more money. It doesn't necessarily need to have reserves. It only has to have a certain amount of reserves from its depositors. It then levers that up to make far more money. It gives us back something, a pittance in return. So it lends the money at 6%. We're supposed to get 2 or 3%. We get like 1 or 0.1% based on whatever the Federal Reserve sets. So the banks can set their own profit margins. But with Decred, it's more of a classic banking model where you say, look, I'm going to save. I'm going to put this money back into the system in order to make sure that the system stays as reserves, as long as it sits there to be to safeguard the value of my savings, and I'm going to get paid in part of the inflation tomorrow. I can then also take that money and build projects for my monetary system, because built into Decred is a whole governance model where we can vote. Right? I'm a stakeholder in Decred. I can vote on, should we do a marketing campaign? Should we raise the block limit and all that stuff? And you vote with what you've staked, and you control that. And that's something that's fundamentally different. And you're absolutely right, Jake, that if we holders or savers of dollars who have all these savings accounts, and we had to vote, we would never vote for the Federal Reserve to print $3 trillion and dilute our savings out. But I'm not going to go off on a Keynesian rant now because.
Well, I feel like another observation here is that the problem that seems to be coming up over and over and over again in so many contexts, whether it's the mainstream media or it's banking or it's governance, it's a question of narratives and a question of central planning. Mm-hmm. That is that there's a human tendency, like we go back to tribal societies and people living in huts and so on. There always was someone who was ultimately in charge, at least in most of these, primitive societies. Despite the fact that we're far more developed and thousands of years past that point, that's still effectively the social structure that we have in, almost everything. I mean, look, Federal Reserve, the Open Market Committee, it's a bunch of central planners who go thumbs up, thumbs down, and then a bunch of people turn a knob, and then it changes the economy. And sure. that process, the fact that, there's a designated list of people, and if you are not on this designated list, you have zero sovereignty. Mm-hmm. That kind of a system going forward, I think is, it's really got to go in the dustbin of history. It just can't scale, and it's just completely unfair.
And I believe that we're at that moment where we're beginning to really truly ask those questions. And the more they push in the wake of the current apocalypse for this, complete surveillance state, both monetary and physical and in every way, and soon to be emotional as well. We're going to be in the Minority Report really. Now, like by the end of the year, we're going to be talking about pre-crime and Minority Report. You wait. I'm about 6 months away from that. Yes, I think enough people are beginning to wake up to the idea that this is what they're doing, and we don't want that anymore. And you're seeing it all the populist wave across Europe. You're seeing it with people still standing by Trump, even though he's a horror show in so many ways, because this is not what we want, and they're trying to force it down our throats. And so I want to shift gears though, because it's a great. This is all really good stuff, but I want to shift gears a little bit because I want to talk about Bitcoin right now and in this moment in time. Plan B, the guy who originally put out the article talking about stock to flow ratio and trying to project out the value of Bitcoin going forward and all of this stuff. His latest article was very interesting because he went through the 4 previous periods of Bitcoin relative to its value in each of the halving periods, and how the narrative shifted along each of those 4 periods. So we went from interesting idea to whatever it was to now it's a financial asset. Now with the next halving, the next 4-year period of Bitcoin, is it going to become a store of value? Well, the interesting part is it's not just about Bitcoin becoming a store of value, but it's about all the other coins as opposed to tokens becoming stores of value. And we see that, and I wonder if that's what, I want to get your take on where we are there and this whole notion of Bitcoin maximalism, which I'm sure I want to get your thoughts on. I know, I do. And I'm going to be honest here. I know the guy who actually coined the term. Mm-hmm. Okay. I've read his work and I know him personally. I've met him, and it's very interesting. And so I don't want to, and I don't mean to disparage anybody. I do want to talk about Bitcoin maximalism. And I actually argue with my patrons about this because I have a couple of them in my who are huge crypto guys, but they're Bitcoin maximalists. So we want to, 1, define that term, and 2, talk about where we think we're going in terms of as the coins have to become stores of value before they can become transactional media, which would be the next phase after that. So in the evolution of these things. So let's talk about that, and let's talk about where you think Decred's going to wind up slotting in, and what other coins have the potential to become very good stores of value.
Okay, so let me think about. Okay, so the first thing you wanted to talk about is the stock to flow ratio from Plan B.
We can talk about that a little bit. I happen to like that argument.
And then what was the second thing that you just asked me about?
Which is about. Let's talk about. Well, we're talking about stores of value. So let's talk about the store value phase. Do you believe that we're moving into the store value phase for potential store value phase for cryptocurrencies? That's one. So let's start there.
Okay, yeah. At this point, I think it's pretty established that Bitcoin has established itself as a store of value. And what do I mean by that? If you buy Bitcoin and then you arbitrarily come back a few months later and you go, whoa, did I make money? The answer is, hey, you may very well not have made money. And in fact, you may have lost quite a bit of money depending on when you bought it. Right. But on a long enough time scale, I know, which is a little bit of an overloaded term, if you go back and you look, let's say 5 years ago you bought some Bitcoin, let's say 4 years ago you got some Bitcoin. If you bought Bitcoin before the last bull market, you're doing extremely well. I mean, Bitcoin before the last bull market was like $500-$600. Mm-hmm. So that's you're up 10x or more, probably more like 20x at this point. So the idea that these things can be stores of value is I think that's already been proven beyond a reasonable doubt. There's plenty of people who are sort of, consensus fiat denominated investment people who are like, oh, that's not a store of value because blah, blah, blah. There's so many people.
I'll name names. They're Peter Schiff.
Yeah,
a good friend of mine, Mike Shedlock, feels this way. Mish, he feels this way. I don't agree with him. I mean, Mike and I've argued this like publicly and on my podcast. I disagree with him.
I think that this perception of value and perception of value and whether something is considered a store of value tie really directly into what you just said with respect to the stock to flow ratio and the way that Plan B creates a pricing model for that. So
sure.
Now just do the super brief recap of what Plan B did. Is Plan B went and said, listen, if we take this model and we look at it and we go, what's happening with Bitcoin when these halvings occur, and as the issuance occurs, is that it is having a monotonically decreasing stock to flow ratio. So the stock to flow ratio starts very high. You're issuing tons of coins the first few years. Then over time that rate decays, and then when these halvings hit, it's an instantaneous halving of the inflation rate or of the issuance rate. So that process, if you take that and you regress the stock to flow ratio with the price data we've seen from Bitcoin to date, then that regression gives you a power law relationship. So that there's effectively there's an exponential relationship between the stock to flow ratio, whatever it is, at the moment, and the market value of Bitcoin. So that was proposed. What was it? I think 3 or 4 years ago now.
No, it was just 18 months ago. Actually.
Oh, just 18 months ago. Okay, well, wow, I'm living in the.
I know, man. It's so much stuff has happened in the last 18 months. I feel like I've aged 5 years in like the last six.
I feel like I've aged 2 years in the last 2 months.
I know, seriously.
Okay, but to connect that, and we go, okay, well that was the relationship that someone was able to derive for Bitcoin. Does this relationship extend to other cryptocurrencies? And someone who works with the project who goes by the pseudonym of Checkmate, decided to have a look at that, and so they ran they took the price series data and then the stock to flow ratio data, which is a lot smoother because Decred doesn't have halvenings,
right?
And then regressed it and found a similar power law relationship for Decred. Which is always, that's nice.
I actually did that for I did a little bit of this last year for the newsletter when I introduced this into an article in the newsletter, and I actually covered Decred and I covered Dash and I covered a couple of other coins at the same time and said, and projected out what would it look like at a certain point in the future. But go ahead. Sorry.
And so the interesting thing about the stock to flow ratio is that the stock to flow ratio takes the big idea from metals, of course, right? Which is that if you look at the way metals are ranked in terms of their market cap or their total supply multiplied by their spot value, that is correlated with their stock to flow ratios. So the things with the highest stock to flow ratios are the best stores of value, and that's just because you can't print gold, right? You can find more of it, but it's slow. It takes a while. It's it's capital intensive and so on. And so gold having a low stock to flow ratio is one of the reasons that implicitly people consider it a good store of value. So to take that and go, okay, let's make this algorithmic, and then make something that has a monotonically decreasing stock to flow ratio, creates something that will have a massive value over time as it's mined out. And then if we look at this in the context of other currencies, it really depends on the price history of that currency. For example, I saw an analysis that indicated that, say, Litecoin really wasn't a good store of value because it only very weakly followed the stock to flow ratio relationship we were just talking about.
Yeah, no, I've noticed that about Litecoin. Here's something else to consider. The minute I read the stock to flow ratio article about this, the first thing I said was, this explains why oil is a terrible money. It explains why silver is going to be demonetized in the next few years, because silver has got industrial usage. Okay. And because it has industrial usage, it's now being pulled out of supply. The whole purpose of stock to flow ratio is that the stored stock of this thing versus the flow, which is the inflation rate, that the massive stock with a low inflation rate creates a high stock to flow ratio, and therefore a high monetary character. And this is a way to quantify the Mises' regression theorem about can a commodity become a money? Okay, because it has to have antecedent commodity value in some form or another in order for it to have the potential to become money. And then does it become that through some kind of do people hoard it? Because if people hoard a particular commodity and don't spend it, it's because they expect it to hold value for them in the future. Otherwise, they would just spend it, or they would use it for its other purposes, like. You don't store wood as for money, because one, it rots, and two, it's more useful building houses out of it. Same thing with oil. Oil is a terrible store of value. So, and it has a much larger point about the commodity, about the value, potential monetary character of a commodity. And so, yeah, there's some. So I look at a coin like Litecoin, and I've always said that I thought Litecoin would become more like silver and become more of a transactional currency than it would become a good store of value. Take it away.
Yeah, and I think that just like you were getting at before we launched into the stock to flow discussion, is right, there's phases and different use cases for different cryptocurrencies. I mean, one of them would be, and I feel like use case is a little bit of an overloaded term, because it's like venture capitalists use use case to sound smart, in the sense that you have some random project, they come up, they go, what's the use case, so they can sound like they know what the hell they're talking about. And if you can explain it in 2 sentences, they're like, wow, that's interesting. And if you can't, then they're like, that doesn't make any sense. But the reality is that it doesn't really matter that much. That said, I feel like, right, so one of these use cases is store of value. I'm of the belief that before anything can become a real medium of exchange, it has to first become a store of value, right? People need to want to hoard it, just like you're pointing out. And once they've started hoarding it, then they start going, okay, now I have a big pile of this stuff. What can I spend little bits on? Can I spend little bits, say, supporting journalists? Can I spend little bits, I don't know, buying computer parts online? And that medium of exchange step is, that's a big step. And I would argue that as much as people, there's, Bitcoin maximalists will say, hey, Bitcoin is a real medium of exchange. It's like, I've been in the space 7 years, pretty active that whole time. It's still just a store of value. That's really the main use case. The main use case is people hoard it because they know it's a good idea to have it. Now, what they're going to do with it and how they're going to spend it, most people haven't gotten to that point. And I guess now am I right to say, so you were talking about Bitcoin maximalism. Do you think it's too soon to get into the maximalism discussion? Or
the last thing I wanted to say, just to finish your point, and I love we're going to do the Bitcoin maximalism. What I wanted to say was that just to remind that there are only two truly economic laws. There's the law of supply, and there's the law of diminishing marginal utility, which is what you just described. When you get to a point where you have more Bitcoin than you need to satisfy your needs and to satisfy your wants, you're going to start spending them, or you're going to stop accumulating them. Okay. The law of diminishing marginal utility. That first glass of water to a man who is dying of thirst is important. The second one, not so much, even though it's still important. The third one, eventually he's drowning, right? So water becomes something. Water has a diminishing marginal utility. From that is derived the law of supply and demand. Okay, and those are the two things that everybody has to remind themselves. We forget about the law of diminishing marginal utility. People like to make linear arguments about things when nobody's demand for anything is linear. All supply and demand curves that you get in first semester economics are based on at what price. It's always they're always a snapshot. They're an equilibrium, and equilibrium is a moment in a much bigger three-dimensional set of curves, for lack of a better term. You're only looking at a slice of real supply and demand. You're not looking on the third vector of price. So the third vector of time, sorry. And so that's what's important about all of this stuff, is that we have to remind ourselves that when we talk store value, we talk this, everything is in terms of the law of diminishing marginal utility. There's going to come a point where Bitcoin is going to hit a moment where it's just, why wouldn't I spend it? Right now, no, I wouldn't spend it. I would save it, because it's better to save it than it is to spend it. So go ahead.
Well, so you touched on Bitcoin maximalism earlier, and I feel like something that is easy to forget, and one of our other project contributors, what is it? NNNKO56 had made a contribution a little while ago that called out cryptocurrencies being misidentified, and that they should really be sort of identified as crypto societies. And so if we look at maximalism through that lens, through the lens of cryptocurrencies really being more about, it's more a form of social technology, and in that sense it bears a lot of similarity to religion, is that Bitcoin maximalism is this idea that there can be only one. And if you've watched any of the, myriad Highlander movies or television series, you're familiar with the Highlander scenario, which is there can be only one, and it's pretty mindless. You cut people's heads off until there's only one left, and then you're the only one left. And then, hey, what if there's more people whose heads you got to cut off? It's like, well, it just keeps going, and then there's sequels. Right. And this process of Bitcoin maximalism is, it's akin to sort of a religious zealotry. This idea that my religion is the only religion, and if your religion challenges mine, I'm going to chop your head off. I'm going to attack you in the street, or I'm going to call you names on the internet, or And I feel like maximalism is normally, at least relative to religious extremism, is pretty tame, right? It's a bunch of people like calling everything a shit coin on Twitter. So, the process, everything's it's all gradated, but the process is really just, it's this idea that if by being the toxic, member of community X, I can enlarge the community, then I'm doing my part and I'm contributing. And I feel like that whole process is pretty misguided in the sense that, hey, if Bitcoin can unseat fiat value storage and transfer systems, what's to say something else can't come along and unseat Bitcoin? I mean, Bitcoin obviously has a big network. It's got good technology, and has a lot of positive things going for it.
Of
but
course it does.
To say that it's the end all be all is like, come on, like, let's. So my view on maximalism is almost like anyone who's like a rabid maximalist doesn't have that many Bitcoin, because it's like anybody who's been stacking Bitcoins for a long time knows, they're like, listen, this stuff's valuable whether there's idiots barking at people on Twitter or not. Like the people barking on Twitter aren't really going to move the needle at all. No one's like, oh, I'm an institutional investor. I saw these people ranting on Twitter and being jerks. I'm gonna invest 3 times as much now. Like, that never happens. So the idea that maximalism is really achieving anything, I think is questionable. And the whole process is really just, it's like tribalism to the nth degree. So I see it, and frankly, I think it's kind of funny, because it's like, I've been the recipient, working on the Decred project, of like, fuck your shit coin and that kind of stuff, just going on and on and on. And it's been going on for 4 years. Right. And I can't even tell you, there's people I know who got super upset. They're Bitcoin people who got super upset when we released Decred, because they're like, no, you were working on Bitcoin, you have to keep working on Bitcoin. And it's like, Bitcoin is a tragedy of the commons. There's no money to work on anything, so we can't. I spent a couple $1 million. We're building out BTC Suite. That's all money in the oven. It's gone. Right. And then how's that supposed to? What am I supposed to do? Raise a bunch of venture capital money so I can have like 4 new bosses that all tell me what to do? No thanks. So it's like this idea that maximalism, that Bitcoin is the one true path. It's like, you may as well be some religious nut at my door trying to like wave books at me and get me to join your religion.
I just find I mostly agree with you, and I understand that that's part of it, and if that helped, and if that was good therapy for you, great. And I don't mean that to be like rude or anything. I mean that sincerely. I know what it's like to get yelled at by people when they don't understand why you're working on what you're working on, or why you're saying what you're saying. To me, I've always looked at Bitcoin maximalism as and all of that. What you said was, I think, the most important, which is that, look, at the end of the day, Bitcoin has a lot of attractive properties. Yes, it has dominant market cap. Yes, even right now, its share of the total quote unquote crypto market cap is rising again after it was falling. But it is a much more democratized market than it was 4 years ago, when it was the only game in town. It's now got to work much harder to get to maintain that. And the question is yeah, you can bolt on new technology, but you still have to then continue bolting on technology that takes you farther and farther from the chain, farther and farther from the core chain itself, farther and farther from the core technology and its core asset. And moreover, and this is the thing that I find very interesting, is there one currency in the fiat currency world?
No, of course not.
Aren't there like 150? And even though some of them are terrible, like I wouldn't hold on to Vietnamese dong, like, for my life, right? I mean, like, no. I mean, maybe as money to like substitute into some of my board games just for novelty. right? As opposed to the money that the cheap money that came with my board game. Maybe, my copy of Raccoon Tycoon. Maybe I'll go buy a bunch of Vietnamese dong and we'll play with that instead. I'm dead serious. Like that, actually, that's a really good idea. Then I think about it. But people own dollars, but the dollar itself, there were dollar maximalists 20 years ago saying the dollar is impenetrable, but no, it's
there
not.
still are dollar maximalists.
Well, I know there are dollar maximalists, right? So I look at this and I'm saying, no, your argument is predicated upon something that is fundamentally unsustainable about Bitcoin, which is its proof of work model will eventually become, if Bitcoin were to ever become big enough to support the entire world financial system, there's not enough electricity generation in the world. There just isn't. Not because the law of diminishing marginal utility states at some point that we're not going to want to divert any more electricity to mining new Bitcoins, especially as the halving rate continues, especially project out another 4 years or another 8 years. Okay. At some point, that fundamentally has to change. And Bitcoins are trading at $1 million or $2 million a piece, but only 1.5 are coming into existence. And the transaction fees aren't covering the network at that point. No, obviously there's no reason why there shouldn't be other coins built on top of that. And I've always looked at Bitcoin as the reserve currency of the crypto world. It's the gold of the crypto world. And then on top of that, you start building layers of it. You start building the layers of Extra's pyramid. And I wrote an article about this 2.5 years ago, and I still think it's probably the most important thing I ever wrote, which is that, look, just rebuild Extra's pyramid, which is the inverted pyramid of the monetary system, but rebuild it as crypto. And then ask yourself what the various levels of that would look like. And why is it that Bitcoin is the only one that has to be that one at the bottom of the pyramid? And two, why wouldn't there be other ones on top of that are better at transacting? Because they're built for transactional. They're built as transactional media.
I think that it's, the situation is challenging, right? Which is that everyone wants to kind of snap their fingers and recreate the existing fiat ecosystem. And the reality is that it's really hard. I mean, this is why things like Lightning Network were built on top of Bitcoin. It's because you can't have tons and tons and tons of microtransactions without the blocks becoming hugely large. And then here's something that you won't hear from most people, but if the blocks get really large, I can tell you what's going to happen. Then all the machines move in a data center. Now, this is something that most people might not realize about data centers, is that data centers are full of government operatives of various flavors.
Mm-hmm.
And so if you go to a major data center in country X, whether it's the US or anywhere else, if you go into a sufficiently central interchange point, you could probably throw a stone and hit somebody. If there weren't any walls in the building, you could throw a stone and hit somebody who works for your favorite or least favorite government agency. Mm-hmm. So this that process of let's just make bigger blocks is that's dead on arrival. So you have to build out these other layers. Something that I find really strange about Bitcoin is that there's a talk about building these other layers. Oh, everything great is going on at layer 2, but it's like, I still think I very strongly believe that there's a lot of stuff that still needs to happen at layer 1, just like you're pointing out with the proof of work, which is that proof of work ends up burning massive amounts of electricity. So what we have is proof of work is a very simple algorithm that burns a lot of electricity and creates a lot of waste. So, hey, can we do better? And is there a way to make to improve proof of work? I think there's a lot of ways to improve proof of work, which I won't get into because I've been brewing these in a pot for years.
Sure.
There's a lot of ways to improve it, but this idea that double SHA-256 and we're done, it's like not quite, guys. So this, I'm totally with you in the sense that pure proof of work has some real serious downsides. And then the other one, of course, is censorships. I was just chatting with somebody and they had said, well, you realize that once nation states get involved with mining Bitcoin, they'll start censoring transactions. And that's a really great point. Like, let's say all the major countries on planet Earth were like, we don't like transactions A, B, C, D, E, F, and G. Right. Those transactions are never going to get mined. And then what does that mean? That means that, once again, we have a centrally planned top-down, system. And so that process is something that you have to constantly fight against in order to prevent, the network from becoming captured.
I couldn't agree more. I got something else. One other thing I want to throw at you is I'm sure that you're aware of a project called Komodo.
Yes.
Okay, so I'm a big fan of Komodo. I have been from the moment I looked at it because I love what I loved about Komodo from the beginning, and it's just to give the listeners a different security model thing. Komodo is built on a proof of work model, like everything else. But what's interesting is that it's a blockchain to develop new blockchains, to deploy new blockchains on top of, which they're successfully doing with their system. And what's interesting is that it's also secured by the Bitcoin blockchain because it throws an audit block out. It hashes up an hour's worth of Komodo transactions and throws them over to Bitcoin to validate that block, so that now in order to hack and do a majority attack on this very small blockchain of Komodos, you've got to also hack the Bitcoin blockchain. So this, what I call security muling, and I don't understand. I can't for the life of me. I'm looking at this going, okay, well, isn't that the model for the future for everybody who wants to do whatever you want? Just audit block each other, audit check each other. Like if your blockchain isn't strong enough right now, and you've only got couple of mega hashes or giga hashes on your blockchain, if you get 10 of those together, you all of a sudden have 10 to the 10th, 10 to that number in terms, because you have to now hack everybody at the same time. To me, like a neural network of audit blocks in each other's blockchains. I mean, other than the technical difficulty of doing it, I just don't think it should be all that difficult, and it should create the kind of neural network web of security that just makes majority attacks a thing of the past, in my mind. Tell me I'm crazy.
So you're not crazy, but there are some caveats, right? So the way audit blocks work is that audit blocks are inclusion proofs into another blockchain. So the way they do that is that they take some of their own blockchain data, like maybe block hashes. And then they anchor those into the Bitcoin blockchain, or vice versa. Typically, what you would do is you'd anchor the weaker chain into the stronger one. And what that does is that allows someone to give a copy or a block explorer for one blockchain to prove that blockchain B is anchored in blockchain A, so that sort of this the immutable ledger is immutable not just in the context of the blockchain you're talking about, blockchain B, but also in the context of blockchain A. So you can piggyback some security off of that. Now we actually do some we make pretty heavy use of that ourselves in Decred, because what we do is we have this thing called Politeia, and Politeia is a system. It's like a website on steroids. So the idea is that everything, we have a proposal system. Everything that goes into that proposal system is then anchored into the Decred blockchain. So for example, if you just had a website, let's say, I don't know, somebody puts a proposal, I don't like it, and then I delete it. Well, what you can do is that you can prove that certain things happened at a certain, on or before a certain date, that a particular cryptographic identity testified to it. So we actually make active use of this process of creating inclusion proofs into our own chain in this case. But it's totally conceivable that other blockchain-like structures, similar to Politeia, or even blockchains themselves like Komodo, can anchor their data via these inclusion proofs into other chains to increase their security. So that's great, but there is a downside. And so the downside is this. The downside is that it places limits on reorganizations, right? Sure. So, you have blockchain A, and then it gets forked, and then the forked branch gets longer than the original blockchain A. Then you want to reorganize to the new blockchain. If you're too aggressive with anchoring data, like these audit blocks, you could get yourself into a situation where your blockchain cannot reorganize. So that's one of the caveats that I just wanted to mention is that
that's good.
You can't snap your fingers and be like, boom, I have all this extra security from Bitcoin without consequences. The consequence here is that if your chain needs to reorganize to another chain, you're going to be constrained by what the anchors you dropped into Bitcoin.
That's interesting. Okay, that's great. That's great clarity, because I did not know from a technical perspective. To me, it seemed very obvious. So one of the things that I know that the Komodo does is that all the daughter chains that are built on top of the Komodo platform actually now have the ability to go back and forth and audit each other within Komodo itself. So now it's become its own kind of neural network of blockchains, which is all built on the same protocol effectively. So probably getting around some of that some of that reorganization problem. I would guess I'm out over my skis saying anything beyond that. So. And I wouldn't what's the word I'm looking for? I wouldn't purport to say that I would know. So that would be insane. All right. So that's all great, Jake. I really appreciate that you saying that. So sounds like that to me sounds like an episode. Like that's a really good thing. In general, I really appreciate your time and your enthusiasm in this, and I really do appreciate the work that you've done on Bitcoin, I didn't know that you worked on Bitcoin, so that's even better, and Decred in general, because I think that it's projects like these that we have to get some amount of discussion in the marketplace so that people get past some of the worst misconceptions about what it is we're actually dealing with here. Because this market is only going to get bigger and stronger over time, because as we've discussed at the beginning of this process, this podcast, that the incentives are there for that to happen, because the very people who think they run the world right now are rapidly losing control of that world. And so I'm going to give you the final thought on this on our way out the door.
I feel like cryptocurrencies, we're going into a very tumultuous period of history here, where there's massive deflationary events like CB19, and then there's massive inflationary events like central bank printing, and then you have you get to choose. Do you want to be part of the inflationary system where your money gets diluted to zero, or do you want to be part of a system where we've all agreed and will likely continue to agree that artificial scarcity is really the way forward, and deterministic issuance is the way to manage our own expectations and create a fairer world around us? Mm-hmm. And I feel like it's easy to focus too much on the price when it comes to cryptocurrency markets. And that's part of the game. It's not a fun game if everybody loses. But the real future that we're walking into is one of a new kind of social technology, and I believe that blockchains are effectively the infrastructure that we're going to be seeing used incredibly actively over the next several decades. So there's an enormous amount of work to do, and a lot of changes to make, and a lot of unfair things and rigged games to unrig. Mm-hmm. So the entire space has its work cut out for itself, and I feel like I'm doing my best to move the peg forward with Decred and with the great team of people we have working with us, and I hope I can continue that process for the foreseeable future. And it takes a village, and that includes people like you, Tom, who are switched on enough to be aware of it, and considerate enough to give us the opportunity to talk about it.
More than happy to, Jake. I really, really appreciate it. And like I said, I needed this refresher course on what was going on in the crypto space, because I think you're absolutely right that the one thing we haven't talked about is that I think we are on the verge of a new bull market in the crypto space in general. And because of that, we're going to start to get back into that mania phase is going to probably start to happen over the course of the next 6 months to a year as things get worse in the real world, quote unquote. And when that happens, I want people to be prepared to manage those expectations, because the last thing I want to see happen this time is what happened at the end of 2017 and 2018, when it was very obvious what was going to happen. So thank you again for this, and maybe one of these days we'll do this again sometime soon. I really appreciate your time and effort, and we'll talk soon, man. All right, thanks.
Great to talk to you, Tom.
All right, well, that will put a bow on the 34th episode of the Gold, Goats, and Guns podcast. I appreciate everybody sticking around and listening to the whole thing. Decred is a very interesting project, as I've said, so if you're interested in it, you can go over to decred.org. That's decred.org. There will be a link in the description to this podcast down below. If you're interested in Bitcoin and anything else, of course, you can subscribe to the Gold, Goats, and Guns newsletter, where we cover cryptocurrencies along with gold, silver, the commodity markets, and everything else as part of our portfolio strategy to help you make sense of this world going crazy. As always, you can follow my work over at my blog at tomluongo.me. You can follow me on Twitter at TFL1728. That should do. You guys have a great week. We'll be back next Tuesday with something else. I'm not sure what it'll be. So you guys take care. You be well. Keep your stick on the ice.